So that's great. And if you have questions, put them in the chat room, put them in the Q&A window, put them, we will get to them at the end. And over to you, Alex.
Perfect. Thanks, Craig. Thanks, everyone, for being here. Today, we're talking about the Canadian Equity Crowdfunding Rules and specifically what's changing in 2021. So if you didn't know, there's a change in the equity crowdfunding rules that is coming into effect September 21st, 2021. And so we're going to talk about sort of in general equity crowdfunding, what that is in Canada, and what's changing with these new rules. So what is equity crowdfunding and what is crowdfunding in general? So you've probably heard about crowdfunding before if you don't know about equity crowdfunding and you've thought about things like Kickstarter or GoFundMe. So there are actually three different types of crowdfunding. The first, donation-based crowdfunding, is like GoFundMe. So that's raising a campaign where you accept donations from people. So you provide nothing in return. And it's usually to help with something. In the US, this is done often for medical bills. The next, rewards-based crowdfunding, is something like Kickstarter. So you'll have a company that's making a product, and essentially they make that product available in exchange for funds from community members, and those individuals are essentially pre-purchasing the product. So they give the company money, the company goes off a couple of years later, they have figured out and built the product, and then they give the product to the community members who supported them at the beginning. And the last one, the one we're here to talk about, is equity crowdfunding. So equity crowdfunding is actually about issuing partial ownership in the form of stock to investors without the company needing to fully go public. So smaller investors in a large group coming together to help support a small business. In exchange, they get some ownership in that company. How does that work in practice? Companies can't go directly to the general public and get investment. They are issuing securities, which is regulated by the Canadian securities regulators, as well as the regulators in all the other countries. And the regulators ensure and mandate that there is a third party in the middle to help protect both sides and make sure that sort of everything follows the rules properly. And so that third party is a platform like the one I operate with my team at Equivesto. So you'll have companies come to the platform, structure a deal, and present their offering on the platform. Investors, many large number of investors with smaller amounts, can come to the platform, look at deals, and put their money towards different businesses. The platform sort of aggregates those funds and then gives them to the business if the campaign is successful. So what exactly do investors get through equity crowdfunding? You get partial ownership. You actually own a piece of the small business, just like if you were buying stock on a public stock market. However, companies can choose the type of shares that they issue to the public. It also depends on the structure of the business. Typically with equity crowdfunding, because you're getting a much larger number of smaller investors, companies will issue non-voting common shares so that the individuals are owners of the business. They will share in any of the profits and benefits of the business, but they don't get a vote. They don't get a say in how the business is run. So where does equity crowdfunding sort of typically fit in the capital life cycle of startups and small businesses? This is really controlled by the limits set by the regulators around how much companies can raise per year for and through equity crowdfunding. So with those current limits in place, equity crowdfunding fits sort of between family and friends and the venture capital space. So you would have your family and friends round first, you're raising 100,000 or less, and this is where you're getting started. You've got a concept only, and you're getting a bit of money to sort of build that out and test it. Equity crowdfunding fits after that at the same stage as angel investors. So this is where you're considering doing a seed round. You're looking to raise, a few $100,000, maybe $1 million. You already have a completed minimum viable product, but you need to raise some money to sort of go to market, begin actual production, and really grow your sales and your marketing. And then after that, you'll have your Series A and all the series after that, where you're raising multiple millions. And this is where you would typically work with a venture capital firm before, potentially many years down the road going public. So what does equity crowdfunding look like outside of Canada? There's equity crowdfunding in many different countries around the world. Canada's been a little bit late to the game with equity crowdfunding approved in the US and the UK back in 2012. And there are a bunch of different platforms all operating successfully in both of those countries, having raised many hundreds of millions for small businesses in both locations. So we can see that equity crowdfunding is alive and doing very well, growing quite rapidly in other countries. And that lets us sort of get a bit of a preview of what it could be like in Canada in the future. In the US, the regulators also just recently modified the rules as well to raise the maximum amount that can be raised by a company per year up to $5 million. So we can see a little bit of a potential future in what the space could look like in Canada, looking at the US and the UK. So this is why you're here. What has changed in 2021? So prior to the new rule change, I'll give you a little bit of history about equity crowdfunding in Canada and the regulatory structure. So I mentioned equity crowdfunding is about issuing securities, and it's governed by the Canadian securities regulators. So there are Canadian securities regulators in every province, and any business is governed by those securities regulators. Whether you're a private business, you're a public business, it doesn't matter. As soon as your business is issuing securities, issuing ownership to potential investors or owners, that is controlled by the rules set by the securities regulators, even private companies. So the standard rules essentially say that all companies need to issue this very long document called a prospectus and go public to be able to bring in investors. However, that is a super huge and onerous requirement. And so there are several prospectus exemptions created by the regulators that allow companies to avoid having to issue a prospectus and go public. So all of these different prospectus exemptions are essentially doorways that private companies can use to raise capital. The most common one is actually called the private issuer exemption. And this is what most startups and small businesses have used in the past. Essentially, this allows you to raise as much money as you like from up to 50 individuals. And those individuals have to be personal friends and family members of yours, or they have to be high net worth investors called accredited investors. So every time a startup goes out to raise capital, or if you've ever raised capital in the past, and you've said, okay, I've never had to report anything to the regulator. What are you talking about? You've actually used this set of rules called the private issuer exemption that allows you to raise capital without having to do any reporting. But if you want to raise capital in other methods, or you want to raise even more capital, you will need to follow the rules set by the Securities Commission. So in 2016, the Securities Commission saw that equity crowdfunding was starting to be a thing elsewhere, and they wanted to, try to create some rules that would allow that to happen in Canada. However, each securities regulator operates on a provincial basis, unlike in the United States, where there's a Securities and Exchange Commission that governs the entire country. What that meant was every province had their own interpretation of what rules around equity crowdfunding should look like. There was no sort of general agreement, and it was all just a mishmash across the provinces. They never really coordinated, and it didn't work very well. So finally, the BC Securities Commission created a set of rules called the Startup Crowdfunding Exemption that some of the other provinces started adopting. And last summer, those rules were adopted by the Ontario Securities Commission on an interim basis as a result of the COVID pandemic, to just sort of allow a little bit more generalized access to that startup crowdfunding exemption for more businesses. Finally, after meeting since last summer, 8 of the provinces have all come together and finally agreed on an improved version of that startup crowdfunding exemption which is what's coming into place in September. So what does this mean for Canada, and what are the differences in the rules themselves? This is fantastic. This is the first time we've really had a Canada-wide set of equity crowdfunding rules that apply across 8 provinces. And it means it's much easier for a company located anywhere across Canada to raise from investors all across the country. So it's very exciting. So what is the main difference? So previously, if we're looking at that rules that I mentioned, the old set of rules, companies were limited to raising $500,000 per calendar year in 2 $250,000 campaigns. So the most you could raise per campaign was $250,000 from the general public, and you could do at the most 2 campaigns per calendar year. Also, individual investors were limited to a maximum of $5,000 with advice from a registered dealer, but only $1,500 if you didn't have advice from a registered dealer. Equivesto is registered as an exempt market dealer, and so when investors sign up, part of our responsibility is to review, your personal financial situation, understand your risk profile and your needs, and help set investment limits that match your personal goals. So just because you sort of signed up doesn't mean you automatically get the $5,000. It means that, if you have more than enough sort of assets and it makes sense, we could approve limits up to $5,000. So the new rules have really expanded both of those 2 items. So now, with advice from a registered dealer, individuals can invest up to $10,000 per year, and the total amount that companies can raise has increased to $1.5 million every rolling 12 months, which is great. Also, now this rule is agreed across 8 different provinces, which is fantastic. And there's been some clarification around passive businesses being unable to participate. So if you think about investing in a company and the purpose of that company is only to buy other companies or buy real estate and hold it, those are examples of passive businesses which are not allowed to raise capital under the new equity crowdfunding rules. So let's break into this into a little bit more detail as well. Who is allowed to operate a platform under the equity crowdfunding rules? So there are 2 categories of entity that can operate an equity crowdfunding platform under these rules. The first is something called an exempt funding portal. So this is essentially just a listing location. There's a series of requirements that it needs to meet, but it's limited in the activities that it's allowed to do. It's only allowed to help companies raise capital using that rule that I mentioned, the startup crowdfunding exemption. Also, because it's not a registered dealer, all investors are limited to a maximum investment of $1,500 per campaign. They're not able to invest the $5,000 and now the $10,000. They're stuck at the $1,500. Also, the exempt funding portal is not legally allowed to provide investment advice to investors on the platform. So if you signed up on an exempt funding portal and you saw an investment and you weren't sure if it would make sense for you, you are not allowed to, you can call the portal, but the portal is not allowed to tell you and learn about your financial position and say, this makes sense for you or this doesn't. The other option is a registered funding portal operated by a licensed exempt market dealer. So Equivesto is a licensed exempt market dealer, and we operate a registered funding portal. So exempt market dealers are fully licensed securities dealers. So our license allows us to help companies raise capital using all of the prospectus exemptions, not just this startup crowdfunding exemption, but we're also allowed to use the startup crowdfunding exemption. We're also required to complete full due diligence, which is called Know Your Product, and a full review and suitability assessment of every investor who's signing up, which is called KYC. And then we're supposed to, having completed both of those reviews, be able to provide advice and feedback to make sure that investors are connected to investments that suit them and their personal situation. We are required to provide financial advice and direction to investors on the platform. But because of those requirements, we're able to allow certain individuals to invest up to $10,000 per campaign based on the advice and feedback we provide. Also, because we can use multiple prospectus exemptions, not just the startup crowdfunding exemption, we can use other exemptions that are traditionally used by startups. So if you were to raise from a venture capital firm, you would be using the accredited investor exemption, that exemption that allows high net worth individuals or organizations to invest in your startup. So as an EMD, we're able to use that exemption at the same time as the startup crowdfunding exemption. So okay, you're raising $1.5 million from the general public, but you can also have high net worth investors invest at the same time alongside the general public, which an exempt funding portal could not do. EMDs also have extensive reporting and registration requirements that we have to meet when we initially get our license and ongoing throughout the year. We're also required to provide audited annual financial statements to the regulators, and we can use, as I mentioned, multiple prospectus exemptions. So that covers who can actually operate a funding portal under the equity crowdfunding rules. So who is actually allowed to participate? So there are two categories of investors who can participate. The first are retail investors, which you can think of as the general public. So this is everyone living in Canada who's over 18 years age, and they have some maximum investment limits set by the platform. On Equivesto, we allow everybody who signs up and meets some basic requirements to invest up to $2,500 per campaign. And if you provide additional information and it's deemed a fit, we can allow you to invest up to $10,000 per campaign. Accredited investors can also participate. Accredited investors are high net worth individuals who are able to provide documented proof that they have over $1 million in assets, excluding, their house or other real estate, and they don't necessarily have investment limits, and they will have personalized investment limits, set based on their financial goals, but they don't have that same mandated investment limit set by the regulator. So those are the two types of individuals who can participate through equity crowdfunding. So who can't participate? It's wonderful that these new rules have come into place and they've allowed companies to raise more money and investors to participate in higher amounts as well. However, these people are only able to participate if they live in a province where the regulator has agreed to this new set of rules. So I mentioned that securities regulators are on a provincial basis in Canada. So really what that means from a company perspective is when a company goes out to raise capital, the rules that it has to follow with regards to securities is not based on the location of the company. It's based on the location of the investor, where the investor lives. So let's say I'm a Canadian business and I'm getting investment in my business from a US VC. That actually means that I need to follow securities regulations and rules in the United States, which I might not have realized. Same if I was to take an investment from somebody in Germany or even somebody from, South Africa or Singapore. I would technically need to follow the securities rules of each of those jurisdictions where the investor lives. What does that mean for equity crowdfunding? Well, Newfoundland, Yukon, Northwest Territories, Nunavut, and Prince Edward Island all do not allow equity crowdfunding as per their provincial and territorial securities regulators. What that means is investors who live in those 5 provinces are not able to participate in equity crowdfunding at this time. As I mentioned, same with international investors. If you as a company were looking to raise money and you wanted to bring on US investors and Canadian investors at the same time, what you'd need to do is run a Canadian equity crowdfunding campaign with a Canadian platform like Equivesto at the same time as running a totally separate US equity crowdfunding platform with a platform that would allow a Canadian company to raise from US investors that's licensed in the United States. So you'd have to basically apply for and get approved for two different campaigns at the same time to make that work. So as a company, what do I need to be able to participate in equity crowdfunding? What are the requirements? So you need to be operating in Canada, as I just clarified. You can be a corporation or a partnership. And actually now the new rules allow you to also be a co-op. If you are a partnership, it's typically limited partnerships that would raise under equity crowdfunding, not a general partnership. And you can raise up to 1.5 million, as I mentioned, in the previous rolling 12 months. So before it was on a calendar basis, so you could raise, $250,000 twice in 1 year as of December 31st, and then 2 days later, January 1st, you could start again. Now it just looks at the previous rolling 12 months and brings that together. No financial statements are required in order to offer securities through the startup crowdfunding exemption, but it is required for you to have a minimum viable product or a demo version of your product or service. But you also, as I mentioned at the beginning, do not need any revenues. What are the ongoing requirements? So the only ongoing requirement is to have an annual shareholders meeting. This is actually a legal requirement of the Business Act. It's not specific to equity crowdfunding. All businesses with multiple shareholders are required to have an annual shareholders meeting. So there's no additional requirement because you're participating in equity crowdfunding. You also have to report the raise in a sort of one-time reporting to the securities regulators where you raised, and at the time of the campaign, you would work with Equivesto or whoever the platform is and the securities lawyer you're working with to get those filings done. And that can cost a few $100s per province. So you do the one-time filing at the end of the campaign, and then you're good to go. Who cannot participate in equity crowdfunding from a business side? So as I mentioned, the rules now clarify who can't participate even more easily. And they are passive investment funds, passive real estate investment companies, and public companies all cannot use equity crowdfunding to raise capital for themselves. The reason why the passive investment funds and passive real estate investment companies are excluded from equity crowdfunding is there's actually already existing prospectus exemptions, those legal doorways that let companies raise money. Those already exist as created by the securities regulators with specific requirements that meet the needs of those types of companies. And so if you wanted to set up a passive investment fund, or you wanted to pool together funds to purchase real estate, there are rules around how to do that already exist that companies can follow. They are more strict and have more requirements because you are making investment decisions on behalf of your investors, and they require more reporting from the companies raising capital. But those rules do already exist, but it does mean you can't use equity crowdfunding to raise capital. So which businesses work best with equity crowdfunding? Really, both startups and small businesses work well with equity crowdfunding. If it's a startup, having an exciting idea that captures the imagination and creates a strong positive impact, either locally or globally, will work really well. Basically, an idea that's going to get people excited. It's easy to explain to the general public, and they will understand how their involvement can really make a difference. That is really what's going to drive your success. On the small business side, having a strong community focus that's going to have a really strong positive impact, again, locally or globally, is also going to be successful. So restaurants, breweries, wineries, community centers, things like that, where there's a real community connection, those businesses typically do very well with equity crowdfunding. What type of business doesn't work so well with equity crowdfunding? Typically, companies where the value of the business itself is actually tied to the employees. So a consulting company or a freelance business, in these situations, it would be very challenging to successfully raise through equity crowdfunding because the business itself doesn't contain a lot of the value. So if the employees were to leave, there wouldn't be much value remaining in the business, and it's hard to get external investors for those type of companies. Also, having a highly technical business-to-business company can also be challenging depending on the industry, because with equity crowdfunding, it's really about going out to an extended community and bringing them into your business. And so if your business is hard to understand or communicate to the general public, you probably don't have an existing community that you can invite in, and trying to build a community around your business can be more challenging. Okay, I'm a company, I fit the requirements. What do I actually need to have in order to apply for equity crowdfunding? So there's a list of documents that you need to provide to a platform as part of the due diligence process. This is different from platform to platform, but this is the list of documents that are needed by Equivesto. You need your certificate of incorporation, or if you're a limited partnership, you need your limited partnership agreement. You need a capitalization table, which talks about who the existing investors and owners are of the business. You need an organizational chart. You need a business plan, a pitch deck, financial statements, shareholders agreement, financial projections, and you need to be able to explain the purpose of your raise and the amount of funds that you're looking to raise in detail. There's one more document that's important as part of the equity crowdfunding process, and this is the offering document. Craig and I have done a couple of videos talking about the offering document in much more detail, so you can check out his or Equivesto's YouTube pages to look for those as well. But the offering document is essentially the legal summary page for investors of all the details about the actual investment opportunity. You can think of it as a more formalized and government mandated term sheet, if you will. So the offering document essentially explains the details of, what is your company, who's involved with the company, has anyone with the company done anything illegal or been convicted of anything, who's the equity crowdfunding platform helping broker the deal, what am I purchasing, what type of security, at what price, and how many, what rights or requirements are tied to these securities, what are the risks of this investment and this company in detail, how long does the campaign last for, how much is the minimum investment amount, what do they want to do with the funds, and the whole document is signed off and certified by the company and provided to all investors on the campaign page. This document is also filed with the regulators at the end of the campaign. And so it's very important to make sure that the document is correct and fully vetted and approved, both by us and the lawyers of the company itself, before the campaign goes live and the document is provided. But this document is a great source of information for any investor to really be able to gather everything that they need to know about this specific investment. That is the end of the presentation. If you want to learn more, you can head to equivesto.com/learn. We have a full learning center with a lot of details about Equivesto, equity crowdfunding, and the whole process, both from the investor and the company standpoint. You can also follow us on social media. But thank you, everyone, for listening, and I'm looking forward to tackling your questions.
That was great. We had a few questions come in, and I've got a few questions, so we might as well get into them. And if you have questions, if you're on YouTube, just put them in you can see the conversation, just put them in this chat window there, and put them in the chat window here or in the Q&A window, and we'll get to them on Zoom. We talked about this. We asked this at the beginning before we started, but I'm going to ask it again so it's on. Can this be done with pre-revenue companies? I'm a tech founder, so I've got an MVP, but need money to engage sales and marketing help.
Yeah, so this can totally be done with a pre-revenue company. There's no issues with that. You mentioned that you're looking to do this to raise funds for sales and marketing. A critical piece to equity crowdfunding is having that community. Even with thousands of investors on the platform, there's no guarantee that these investors will choose to participate in your campaign. And so to ensure the success of your campaign, we highly, highly stress that you put time, effort, and dollars into building your community and detailing a very clear marketing plan for your campaign. One thing you can do for free, though, if you're thinking about doing an equity crowdfunding campaign in the future, is start building your social media presence, building your extended community around your business, getting more people interested and involved. So if you do decide that you want to raise capital, you already have a group of maybe a few thousand followers that you could potentially go to who already understand about your business.
What are the limits about, let me ask this a different way. How many times can I raise in a year under the new rules?
Under the new rules, you have no limits. You're only limited on the dollar amount. So technically, even though limits are still contained to 90-day campaign style raises, you could technically, if you wanted, launch a new campaign every 90 days that lasts a full 90 days for the entire year. And the only time that you would have to stop is if you hit the 1.5 million sort of rolling 12-month limit. Keep in mind, though, the offering document that I just talked about does have a detailed section that asks you to break down if you've run campaigns in the past, why have they been successful, and what were the funds used for. So if you're running a sort of repeat campaign every 90 days, you will need to start detailing a lot of those campaigns and why you sort of keep running more campaigns in that document for the investors.
So that's great. That I can raise multiple times. And you mentioned earlier, it's about 15% give or take for marketing. So I could raise 100K now, and in 6 months, once I've got some money and I've done some stuff, and now I've got more cash in my pocket, I can go out and raise 500K. And
Exactly. Yeah, you actually outlined what can be a very successful strategy. So one real challenge for some companies is obviously you're looking to equity crowdfunding because you want to raise capital. At the same time, to raise a larger amount, you need marketing dollars to really drive and get people interested and aware of your business. And so that's a little bit of a chicken and egg scenario. That is a great strategy where you run a smaller campaign initially, really, on a tighter marketing budget and really leveraging that community. And then once you get some of that money, you can use it to expand the business, grow, but also really have marketing dollars available for a future campaign. Potentially, if you're really able to grow the business and actually hit some great milestones with that initial smaller amount of capital, you could even potentially raise the valuation and raise the price per share. So the investors who participated the first time get some immediate, clear value growth in their investment. And also you're able to sort of make that improvement before going out for, a next larger campaign using some of the funds that you raised for marketing.
Got another question here. If we were to work with Equivesto for a campaign in Canada, could you steer us in the right direction of a platform or partner for US campaigns?
Yeah, so there's a few different here. Let me go back to the US page. There's a few different platforms in the US that are quite sizable, and they are a bit different depending on what you're looking to do. So if you wanted to run a sort of a double campaign, we could definitely help you figure that out. They do have their own application processes, so I would look into those directly, but Republic, Start Engine, WeFunder, and Seed Invest are some of the 4 biggest platforms in the US. So I would start there, look into those. But if you did want to work with Equivesto, we would be happy to really get into a conversation with you and these other platforms directly to try to, time everything well and work together to have a sort of seamless double campaign situation.
Fantastic. Now we talked about this. So one of the major changes is that as a investor, I do not have to no longer have to be in the same province as the company that's raising.
Yeah. So what was sort of interesting before is because there wasn't consensus across all of the provinces around the crowdfunding rules, it was a little bit harder to sort of coordinate and figure that piece out. Let's say you were working with, let's say you wanted to raise capital on Equivesto and you were looking at the rules maybe 2 years ago. If you wanted to, let's say you're an Ontario-based company, but you're raising in Ontario, Alberta, and BC all at once, you would have to be meeting the requirements of raising capital in Ontario, but also raising capital in Alberta and in BC, and those would be different requirements. Some of them would overlap, but some would be quite different. You would even potentially need to create multiple different versions of the offering document for different provinces and make them available sort of all at once. And so it could get very, very confusing because some provinces would have different maximum raise limits and everything like that. So you need to say, okay, we can only take, $50,000 from here, and we can take $200,000 from here, but this place we can take $1 million, and you'd have to figure out which investor was investing which amount from which place. And to be honest, it was just a lot of work for platforms like us. So I'm very happy because now on the back end, what the technology has to do is much simpler. You could raise from different investors in different provinces before, but it did make it considerably more confusing, Craig. So now with this unified set of rules, it's very clear, it's very straightforward. Everyone in those places can participate as long as the platform itself is licensed there.
Great. That is a lot clearer and makes things a little more interesting. Now, another question here. Does Equivesto have its own portfolio of investors that companies will have access to, or do companies need to find their own investors? This is a common question.
Mm-hmm. Yeah, this is definitely a common question. And so I'm happy to address it. There are over 2,500 investors already signed up on the Equivesto platform. However, I'm going to use Kickstarter as an example because it's way bigger. Kickstarter has millions and millions of users on Kickstarter. Kickstarter still says when companies are signing up looking to run a campaign on Kickstarter that they need to expect to spend between 10 and 20% on marketing to have a successful campaign. Why is this? Even with millions of users on Kickstarter, there is no guarantee that those individuals will see and engage with the content that you're putting out as a company and decide to participate in your campaign. And so spending marketing dollars and effort and time to create a marketing campaign is really what's going to make that difference to get people excited, bring them in, and bring them across the line. Also, something that's really important to keep in mind is people are not sitting around waiting for places to put their money. We often think about investors and accredited investors as like, okay, I got to go talk to these people. They've got $5 million that's just burning a hole in their pocket. And if they just give it to me, I know exactly what to do with it. Everybody's getting a Porsche. I mean, we're going to save the world and do all sorts of great stuff. The reality is people's money is already being used somewhere else. It's already being deployed. It's already been invested. It's already doing something. So when you're coming with your campaign, you're not saying, this is why your money should be with me instead of sitting in a pile. You're saying, this is why I can do more with your money than somebody else that's already doing something with your money. And people are going to be looking for reasons why that will convince them to give it to you, but also reasons to not give it to you and to keep it where it is. If you're coming to the market as a new startup, you've got an MVP, you've got no sales, you have nothing else going on, and you've just launched a campaign and it's got a big $0 out of $1 million raised on your campaign page, the fact that you're going to suddenly convince a bunch of people to all jump in all of a sudden who've never met you before and have just seen you for the first time on this campaign page is very unlikely, sadly. What they'll be looking for is proof. We talk about the fear of missing out sometimes and, people being worried. And, we try to give investor education, and we hope that, individuals coming on our platform will be able to get all the information they need and see the due diligence that we've done to be able to make a very robust, formalized investment decision. But part of the reality of it is people will be looking to see what other people are doing. If nobody has come in to invest in your campaign and it's already the second week, people are going to say, maybe somebody else is seeing something that I've missed. I'm not going to invest yet. I'm going to hold off. So having a community of people who already know your business, who are your extended family and friends, who are your customers, who are your suppliers, that the community around your business, they're following you on Instagram for the past 2 years or whatever. They know that you're real. They know what you're doing. They know what you're working towards. They are further along that process of getting to know you, getting comfortable with you, and trusting you than somebody that you've just met somewhere else. So these people are really important to keep educated about what you're doing, keep them excited, keep them engaged, so that if you do run a campaign, they can potentially come in and invest at the beginning and really demonstrate that initial traction. You need to be looking at bringing in people from there to at least have some initial interest to show, okay, if your extended community, if the people you're already working with aren't going to invest in your business, why is this other guy? If these people who already know you don't trust you with their money, why should other people? People are always looking for that sort of societal proof to come in and support that. And then after that, using marketing to help expand and grow your message will really drive for your success. So even though Equivesto has several thousand investors, signed up and active on the platform, with every company we talk to, we actually say, expect to have to get 100% of the dollars you're looking for through your own community growing efforts. And anything that you get that's extra from the platform and existing investors is a bonus. But part of what we're trying to do is improve accessibility to capital, but that doesn't mean that we're going to go to every single person signed up and say, like, you have to invest in this one business and everything. That's not the way that we do business. And part of our responsibility is to protect their financial interests as well. So we can't say, we've got a huge group of investors and we promise you that they'll come in and fully fund your business. Sadly, that's not how this works.
It's so true. And once you get momentum, once people start investing, that's when other people want to invest, because they see that social proof, they see that your investors are starting to rise, and a little FOMO kicks in, and it really helps the situation. Here's another question from the chat room. You can answer this in a more expanded fashion. What are the front end costs associated with a campaign? Does Equivesto charge a fee pre-launch?
Yeah, so that's a great question. So first I'll talk about the Equivesto fees, and then I'll talk about some expanded fees. So Equivesto charges 2 fees. We have an application fee, which takes place before the campaign. That's $2,500 Canadian. That's to cover some of the cost of the due diligence that we do on your business. And then we have a second fee, which is our sort of success fee, and that happens after the campaign is successful. That is a 7% fee. So we take 7% of the total amount that's raised, and we take that as a cash fee after the campaign is successful. If the campaign is not successful, we don't take any additional dollars from you. In terms of expanded additional fees, what are some other things that you need to look out for? Really, I'm going to highlight 2 other areas of potential fees, and that's going to be legal services and, as I mentioned already, marketing services. So let's talk about legal services first. So there's that whole list of documents that I've got here that you need to have prepared in order to run an equity crowdfunding round. So you'll probably need a lawyer to help prepare some of these for you. Not necessarily, you could have had made almost all of these all by yourself, but having a shareholders agreement, you probably want a lawyer to review or look over that. But let's say this is done entirely on your own, which is fine, and you've come to us, you've never worked with a lawyer before. The offering document itself will have to be reviewed, and you'll need help preparing that from a securities lawyer, not just a regular lawyer, small business lawyer. You'll need help from a securities lawyer specifically to review and look over this document. We have a couple different securities lawyers that we've worked with many of our companies that we'd be happy to make a referral towards, but you will need to work with a securities lawyer on that to make sure that sort of everything is matching. If everything is all properly structured beforehand and you just need help with the offering document, that might take maybe 3 to 5 hours. And one of the securities lawyers we can refer you to is around $300 an hour. So you might want to budget $1,500 Canadian for the securities lawyer to help prepare the offering document. At the end of the campaign, you're going to need the securities lawyer again to help you with the filing. Equivesto doesn't charge any closing or filing fees because we're not, we want to provide a lot of that help for free. but your securities lawyer will need to file some documents with the securities regulator on behalf of your company within 30 days of a campaign closing. We do a lot of the work ourselves to sort of draft those documents to try to minimize the work for your lawyer. Again, we do that for free, but they'll still need to spend probably 1 or 2 hours getting those filings done. So that'll be another couple $100 for your securities lawyer at the end of the campaign, as well as I mentioned the filing fees with each of the provinces, which is around a few $100s each. At that time, though, you're only doing the filing and the closing if you've already raised your funds successfully. So you should be getting money from that, which should help cover those costs. But you will have a few extra dollars to pay for your lawyer as part of that closing process. So that's the legal side. If you need, going to go back into the legal side for a second. If you need more detailed help, you need help creating a new share class, you need to very much revamp your shareholders agreement, plan for additional hours as part of that. These are costs that you would have to spend anyways if you were raising capital from a venture capital firm or some other external source as well. And these are costs that would actually come out of the money that you've raised. Let's say you've negotiated with a VC firm back and forth, both of you paying lawyers when you've talked about changes that you need to make to your shareholders agreement to actually get that investment from the VCs. The VC sends you the bill for the legal services of their lawyer during the funding process, and they don't give you any extra money as part of their investment. So if you're raising $100,000 from a VC and you spent 20 grand on a lawyer and they spent 20 grand on a lawyer, congratulations, you actually only raised 60 grand from a VC, or sorry, yeah, you raised 60 grand because you spent 40 grand, 20 and 20 on the legal fees. So you do need to keep that in mind as well. The other area where there will be some fees is on the marketing side. So as I keep saying, building that extended community, building that network on social media and in general around your business, and specifically having a detailed marketing plan for your campaign is a critical piece of success. A lot of that work you can do for free to try to build that up and get prepared, but you should plan to spend 10% of your target raise on marketing dollars. That's going to be a split of hiring a marketing firm, but also actual ad spend to Facebook, Instagram, wherever, to put ads out there to sort of bring people in. So there's a split there. In terms of paying the marketing firm, you might be able to negotiate with the marketing firm to pay them after the campaign is successful. Typically, some campaigns, some firms will have their fees come and be payable after the campaign, which can make cash management a bit easier. But the actual dollars to Facebook, Instagram, LinkedIn, Google, where your ads are going, those dollars will still need to be spent prior to and during the campaign. So you will need to budget for that, and that's dependent on the amount that you're looking to raise.
Fabulous. That was great. I think we're out of questions. Oh,
There
no.
was a question in the chat, I think, about Quebec.
Oh yeah, sorry. I are there any issues with the province of Quebec?
So yes and no. Quebec fits into these new rules. So if a platform is licensed in Quebec, you can raise from investors in Quebec using these new equity crowdfunding rules with no problem. Equivesto as a platform is not yet licensed in Quebec. Part of the challenge with a platform looking to get licensed in Quebec is we need all of our documents in French, including the documents that you are going to be using when you're issuing securities. So looking at the offering document right now, one thing to keep in mind, you would need to potentially prepare an offering document in French as well as the one in English. And so your legal fees to your securities lawyer to sort of get everything ready potentially just doubled because they will need to prepare a similar document in French as well. And you might not have a securities firm that has French speaking lawyers. So maybe you'll need to hire a Quebec one. So that could potentially be additionally challenging. But from the rules perspective, there's no additional problems. Quebec participates in this rules just along with everyone else.
And if people want to find you, learn more about Equivesto, where do they go, Alex?
Yeah. So if you want to learn more about Equivesto, you can head to equivesto.com, which is our website and the location of the portal. Specifically, if you go to equivesto.com/learn, that's where there's a ton of information about equity crowdfunding and the whole process, company side and investor side. We actually have a little boot camp that you can go through that really like catches you up to speed on the documents you need to prepare, what the process is going to look like, and everything like that. You can follow us on social media, Instagram, Facebook, and LinkedIn at Equivesto, on Twitter at Equivesto Inc. And you can follow me. I'm on LinkedIn, I'm on Twitter, and you can shoot me an email directly, alexander.morsink@equivesto.com, and chat. Of course, we have sessions this week on Friday, one-on-one with me, organized by Craig and TorontoStarts. So if you like hearing my voice and you want to hear more of it, we can set something up on Friday.
Yeah, if you're interested, you have questions about your company, what it would take, what a campaign would look like, valuation, all that kind of stuff, click that link I put in the chat room. I'll send it an email out in a couple hours after this, so you have it. You can book a free 1.5 hour session with Alex and just discuss any questions. Find out whether it's right for you. There's no pressure.
Exactly.
So thanks again for taking the time. There's a lot of good information, a lot of new information. I'm excited about the multi-province, excited about a bunch of these changes. I'm really looking forward to seeing what happens next.
I am as well. Thank you everyone for joining, and hopefully I'll see you on Friday.